Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
That's going out there. It's November 15th. I'm Frank Curzio. It's a Wall Street Unplugged, so I break down headlines and tell you what's really moving these markets. To start this podcast, I just have one important thing to say. Rock Chalk Jayhawks! Man, I love college basketball. By far, my favorite sport. You guys know I play basketball for most of my life, and I'm getting back to it after my hip replacement, my second one. I'm actually going to start playing. We'll see how that goes. Going to keep living. I don't want to be conservative in my life. Man, college basketball is awesome. Yeah, Kansas played Kentucky last night. Started 9:45. Nice night game. They wound up winning the game, probably because Kentucky was missing 3 of their 7-footers, which are all coming back in a few weeks. But Kentucky looked really good. Lots of freshmen as usual. Calipari. Great team. Insane. Athletic as hell. Made some mistakes at the end, but definitely a team to watch for the tournament. Kansas ranked number 1 to start the year, mostly because Hunter Dickinson transferred from Michigan to KU. And by the way, if you're watching our video on YouTube, here's my nice national championship bottle for Kansas, for KU. It's awesome. I actually went to that game in New Orleans, watched them win after being down by what? I think it was like 14, 15 points going into half. Yes, I was nervous, but they won. They're the best team in the country. Again, Hunter Dickinson is amazing. Left Michigan to go to the final year to Kansas, which is kind of weird. You really don't like that. You see that in baseball as well. And you know, all the players, especially midway through the season, they all just join another team. If you're doing really bad in football, we saw it with Washington. You know, Washington lost the game, they get rid of everyone, and then you have the Chiefs picking up, you know, Chase Young and stuff like that. It's kind of crazy. But he wants more exposure, and he got it. He's got 27 points, grabbed 21 rebounds. First player in KU, which has a storied history in 25 years to do that. But I just love college basketball simply because they have these great games at the beginning. They have these tournaments like the WV Classic, the Maui Invitational, Phil Knight Invitational, Empire Classic, and they put up the best teams against each other right away. And they want to play these games because they want to see where their team is at. And you don't see that in college football. The first 4 or 5 weeks are usually horrible. I mean, they're getting a tiny bit better. You saw Ohio State play Notre Dame, like third game. You saw Texas play Alabama. But if you lose one game in college football, you could be done for the year, depending on what your schedule is. Maybe, you know, you don't play as many games, where at college, it's all right off the bat. Boom, you play Kentucky, you play Duke, Michigan State, you see all these great games. And you know, you just trout Tennessee is great this year. UConn is great again after win national championship. Michigan, Purdue, Arizona. It's really great to see all these teams get together. It's like right out of the gate. Awesome games, really cool, competitive, getting in your face. It's just awesome sport. And looking forward to watching Kansas for the rest of the year, even though they should have lost that game last night. Outside Kentucky playing bad the last 3 minutes, they actually should have lost that game, but they have a great bench, great team. They look really good. How to start the podcast off with Kansas. Come on, guys, you know. Now let's get to the bull markets. Since you really don't need me in bull markets, just buy anything, you got to be fine. But not really anything. I think the average stock price, even after the rally in the past 2 days, is still down. It was down 6%, I think, as of last week. So you might think everything's going up, and everything's going up right now, especially the past 2 days, but it's still been a difficult year for a lot of investors unless you own the top 5, 6 stocks that continue to go higher and higher. And those are the 5 largest technology stocks, where Apple and Microsoft now account for 15, 16% of the entire S&P 500. And we all hear about the 25 or 30% for the top 10. I think it's the top 5 or 6 of them, including Tesla, account for, and NVIDIA account for, 25% or 23% of the entire index. So, you know, it's really heavily weighted. But right now, it's a bull market again. Buy everything. We're all okay. Nothing to see here. We had the CPI come out on Tuesday. Showed inflation moderating. Better number than expected. And we had a rip-your-face-off rally. I love when people say, rip your face off. But that's going to be the word. Actually, that's going to be the phrase of this podcast. Rip your face off. Rip your face off rally. And then what do we have today? The producer price index came out. Estimates called for a gain of 0.1%. I know it's a producer price index. Nobody really pays attention unless, you know, you're really into the markets. That's the wholesale prices, but it's a big deal because it fell 0.5% when estimates called for a gain of 0.1%. So it turns out that's the biggest monthly drop in wholesale prices since early 2020. Huge. So we have this push lower in rates, which is good, right? They fell sharply, and that's good for equities, which at least I think that's good for stocks. I'm not sure what's good for equities and what's bad for equities anymore. I should say I don't know what's bad for equities anymore. We watched a 10-year go from 3.8% to start the year to 5%, and stocks ripped higher. If we look at all the data that comes out, whatever it is, it's always going to be good for equities. You know, higher rates, low rates, markets go higher. Earnings growth, no earnings growth. Stocks go higher so this year. Slower CPI, slower PPI, which indicates an economy that is slowing. That's great for equities, too. Wars, no wars, great for stocks. And hell, you have Biden meeting President Xi. If he punched him in the face and said, hey, we're taking over Taiwan, that's going to be great for stocks. Of course, if Biden did that, if he punched anything, it would probably be like watching a turtle move in slow motion. It'd probably take 20 seconds to get there. I mean, it's getting progressively worse, right? I mean, whenever I see it on camera, it's sad to say. I mean, this is the leader of our nation. Yeah, it's just painful. It's painful. But unfortunately, it looks like we're going to be stuck with Trump or Biden, one or the other. So good luck with that, especially if you're watching anything in the media, because, you know, we're all going to hate each other forever. Can't be friends at all. So that should be interesting. But in all honesty, when I'm looking at these markets, we're coming off incredibly oversold conditions from about a month ago. And we have seasonality in our favor. Seasonality is serious. You can't just look at different figures and say, okay, well, interest rates are much higher this season. It's seasonality, what that means. And we talked about this last week, right? On why I'm bearish on the overall markets, but we're going to see a strong rally into the end of the year. And we've been saying that for the past couple weeks. When you see this seasonality, and especially this year when so many money managers are underperforming. They're underperforming because if you didn't have 6 or 7 stocks, you're significantly underperforming your benchmark. And you want to play catch up, which is called alpha. You need to generate alpha. And it's all about your benchmark. It doesn't matter if you're down 20%, the market's down 20%, and you're down 18%, you beat your benchmark. Especially if you're up. You're going to get bonuses, you're going to keep your job. But if you go 2 years, 3 years, and you don't beat your benchmark, you better look out because there's 20 people right behind you going to take your job. So, you know, they're fighting for this. And also, seasonality is you're seeing tax law selling. Going to get to Target later. You wonder why Target went down to 100, 102. I mean, even if you're looking at funds that cover retailers, especially their competitors, look at where Walmart is. Look at where Costco is and how great those stocks did, where Target's down tremendously. So what are you going to do? Well, I'm going to sell Target and take the tax losses. And that's why you see a lot of names that got punished go down even further towards the end of the year. And a lot of the names that have been doing well go a lot higher. And we took the time of Wall Street Unplugged Premium last week. This is on Thursday, and Daylight listed and went over 25, 30 stocks to buy into year's end. And these are momentum names that we said are likely to surge over the next few weeks. And this is because portfolio managers are shifting their allocations. They need to generate that alpha. And with that seasonality and still being a little oversold, at least before this week, it made sense to get into a lot of these names that are continuing to move higher and higher and higher. And we really nailed that. I mean, if you paid attention, you probably made enough money in just the past 2 trading days to pay the $10 a month for Wall Street Unplugged Premium for the next 5 years. I mean, that's the point of that product. And look, if you're new to Wall Street Unplugged or listening to me the first time, you should be skeptical. Okay, there's a lot of clowns out there selling crazy trading services and all this garbage. Been doing this for a long time. So all you out there, if you want to try it, you go to WSUPremium.com. I have an offer on there where you can subscribe to Wall Street Unplugged Premium for just $1. That's it. So you can test it out. If you like it, cool. It's going to be $10 a month going forward. So you get the service amounts how much you pay to fill up your car in a week. If you don't like it, you can cancel. That offer for just $1, Wall Street Unplugged Premium, available at WSUPremium.com. And the service also includes Dollar Stock Club, that portfolio. We provide a trading idea per week, detailed analysis on it. But right now, Dollar Stock Club has 22 stocks in that portfolio, and that's also included in that membership, right? So we have energy plays in there that are doing well. Crypto, we really nailed as well. Crypto is on fire. It's a little past couple of days, but really, really strong, especially over the past 2 months, really. But we go anywhere with this newsletter, right? It's just trading ideas every single week, and it could be large caps, small caps. Like I said, crypto, we're really big on uranium, which has been on fire. And by the way, real quick, guys, I'm interviewing Amir Adnani, right? His CEO, founder of Uranium Energy UEC, that's sitting at a 52-week high. I interviewed Amir, who's a very close friend, in January. And I say very close friend, I know him for longer than 10 years. Back then, he told us uranium prices were about to double. He's always been, of course, very high in uranium price, and he should be because, the industry was just ripe for prices to go higher. But he said uranium prices were about to double. And I don't think he says that often. He says, well, prices are going to go higher, but he said they're about to double. They were trading at $31 a pound then. There's $74 a pound today. Nice call. Amir's one of the smartest minds in the world when it comes to this sector. He founded UEC in 2005, travels across the world, relationships with presidents, prime ministers, and even, heck, the former Secretary of Energy, right? Spencer Abraham is the chairman of UEC. So the contacts that he has, and just, I talk to him when he's on the road, and just seeing him work, and it really goes to the credibility of a person like this, who's been in an industry that's been shit since Fukushima. I mean, you talk about this drag, and even though the last 4 or 5 years, you've seen the fundamentals change where it makes sense. It's just been this whole thing, well, clean energy, and nobody likes uranium, right? Nobody likes nuclear, right? Everyone's like, it's dangerous. And now you've seen that change a lot. You've seen people saying, okay, this, again, when it hits your pockets, and even with corporations, when they realize they can't make money, you've seen, clean energy stocks get annihilated now because they just can't make money. Now you're seeing, well, we're sitting here with something that's absolutely perfect. We have an abundant supply. We have a massive amount of supply in the U.S. Massive amounts. I don't know if you know this, but oil companies in the 70s, 80s used to be the biggest producers of uranium before they basically outlawed it. So they know what all the uranium is. We could produce the hell out of it. But we've always said, hey, you know what? Let's just rely on Russia, Kazakhstan. Let's go, import it. And you're seeing over the years where, for electricity generation, the supply and demand imbalance was insane, where they had to lock in these contracts, and we were always wondering where prices were going to go, right? How come they haven't gone higher? So the interview is going to be great. We'll cover the details of the supply demand again for uranium, which suggests prices are likely going much higher from here. This isn't just like, hey, we're going to 75 in a quick blip. I mean, even at 75, they're depressed. I mean, I never thought we'd see 35, 40, 50, and they'd stay at those levels. But now it makes sense where you're going to see actually U.S. companies and companies around the world start actively producing. Because this is a product that probably costs $55, $60 to produce, a little bit lower in some areas, but on average, now it makes sense. Especially if you're locking in future contracts, higher valuation, where it makes sense that you could actually start producing this, not just sitting on the supply. I mean, you want to buy gold when no one's really producing gold because you're going to get it in the ground for like $7 an ounce. It's a fortune to produce it. Unlike uranium, it's not as expensive. But then once you do and prices go higher, now that's worth $20, $30 in the ground, or you get some of the big guys to come over and produce it. But you guys know what I mean. So Amir, through this whole entire terrible bear market, has been just acquiring assets for UEC, acquiring assets, getting bigger exposure. Just improving his relationships with industry leaders all over the world, getting involved in politics, and just seeing someone work so hard in an industry that's been so crappy. It's just a testament to his dedication. But he's going to talk about these trends, including what countries are ramping up capacity, and more importantly, I'm going to ask him what specifically changed about this market. Because I mentioned, the past 5 years, that supply-demand imbalance was pretty much the same as it is today. And I hear Rick Rule in my ears saying that the cure for higher prices is higher prices. And saying that, uranium prices have no place else to go but up. But what has changed specifically this year when now you're seeing, I don't know if it's political or whatever. Again, I didn't do the interview yet. I'm going to do the interview. But I'm curious to see what has changed this year to make this spike happen. Because I thought this spike, and a lot of people thought this spike would happen a year ago, 2 years ago, 3 years ago, and it hasn't. So we're going to cover a lot. It's going to be a nice interview. And I'm going to send this to you next week. So I'm interviewing in a couple days. And next week, we're going to be closed for Thanksgiving. Plus, I'm taking a much-needed vacation with my family. I'm going to go to the Dominican Republic. It's been stressful with the house, as you guys know. You guys know everything about my life. It's so weird when I talk to subscribers or Curzio One members who I talk to a lot, even shareholders and stuff of our token. And they're just like, oh, how's your house doing? And I've never talked to them before. You kind of just, just say everything, and everything just comes off the cuff here. But, you guys know pretty much everything about my life. I just leave everything out there, right? I'm very open. So, stressful with the house. Kids just made their soccer basketball team, so we're driving all over the planet and everything. I explained that. I made fun of it on last week's podcast. Just work and everything, right? So we're looking forward to just hanging with my family, relaxing for Thanksgiving. But I'm going to publish this interview on iTunes. Also send a direct link to all the Curzio Research members and podcast listeners. Definitely a must listen to. We've been involved in uranium and dollar stock club. We have lots of good plays in there. I told you one of my favorite plays, Encore Energy, which is also at a 52-week high. It surged. Uranium is a place to be. It's not just like, hey, it's cyclical. But oil's good, and then when other stocks are good, then oil's not that good, and back and forth. I mean, this is something where you have the fundamentals behind it. You have the momentum behind it. And I'm not going to say that the easy gains have not already been made, but, I mean, we are probably in the second to third inning of this. We have a long way to go before we see really this sector develop and go forward. So that interview is really, really cool. Definitely must listen to. And you're going to see me do a lot more interviews. We took a break from interviews just for a little while, kept it simple. But a lot of people I just want to copy. I'm going to reach out to. Just have a lot of CEOs reaching out. A lot of industry specialists that I think are going to help you tremendously. I never have like financial planners on this show, right? That doesn't make sense. I don't have, people that aren't going to help you, right? And I'm not being selfish here. I think I know my audience, but my audience is, I think you guys are kind of like me. Like I want to be educated. I want to hear a different opinion. I want to have an open dialogue. If I disagree with you, I'm not going to be an asshole to you, right? And, seeing some of these people that want to have interviews, I really think that they're going to be really good. It's going to benefit you. It's going to educate us all. I like having interviews where people have a different opinion than me. I think that's where you learn the most and be respectful about it. But really, really cool interviews coming up and starting to book a lot of them. So expect those through December and into next year. So very excited about those. But I am taking off next week. So guys, for Thanksgiving. And that Amir interview I'm going to publish early next week, so you guys will listen to. Definitely must listen to. So let's get back to the markets. I will say, when I look at the markets here, in the past 4 weeks, and I think you got to get used to this. I mean, we've seen a market go to incredibly oversold to now overbought. And we highlighted, like a lot of the sentiment indicators, contrarian indicators that was saying that the market, should be coming down. It should be coming down. It came down. And then, we really sold off very quickly. You got to get used to these moves. Because right now, we're overbought. Not at extreme, super extreme levels. I think we still go higher into the end of the year. But we are getting to overbought conditions now because we've seen massive rallies. I mean, 5% rally in the Russell alone. When have we seen the Russell outperform every other, it's outperforming the NASDAQ, right? Nothing outperforms the NASDAQ, right? So it's outperforming the NASDAQ. Even today, when you look at stocks, right, we're up, 0.5% as I'm doing this in midday. It's outperforming 3-1, the Russell, right? Small caps. Why? Because they've been down significantly. They're still down right now, 25% from their highs. The S&P 500 is down 5% from their all-time highs. I mean, it's a sector that's been annihilated. But looking into 2024, I mean, guys, let me put it to you this way. Okay, because if you're going into 2024, when you're watching TV, I'll go over that in a second. Everyone's just like, hey, the market's going higher. It's great. It's going higher and higher and higher. If we go back to March 2022, this is right when the Fed started raising rates. And I asked you, where do you think the markets will be today? And before you answer that, I said, but hold up. Okay? I told you, these are the conditions that are going to happen. The Fed is about to raise rates from 0.25% to 5.5%, the highest rate in over 2 decades, the fastest rate hiking cycle in the history of the Fed. If I told you that mortgage rates will more than double from 3.8% to 7.5%, that's the highest rate since 2000. If I told you that inflation would surge to a new record, and even now still be twice as high as our normal rate. Looking at the core, still 4%, right? Double the Fed's target. And I told you over this time period that we're going to see relatively no growth in earnings or sales in the S&P 500 until today. Would you say the S&P 500 would be higher or lower? Because based on those conditions, if you asked me, and I was really honest, I'd say the market has to come down at least 20%. We're up 5%, the S&P. 5% higher than in March 2022 when the Fed started going crazy and raising rates. So think about that. What would happen if the Fed didn't raise rates? We'd be at 7,000 on the S&P 500? I mean, where would inflation be? Hey, it's crazy when you think about it. What if we did nothing? Okay, inflation goes higher. But think, where would the markets be? Look at what we did. I mean, this is significant. These are significant moves. I mean, when you see no interest rates, I mean, you look at credit tightening, you're seeing the effect of interest rates all around. People can tell you the economy's doing good. Just listen to these calls. A lot of these companies are beating. They're not seeing earnings growth year over year. A little bit for the first time this year they saw it. Some companies, most companies aren't. They're seeing sales decline year over year. But why their earnings go bad? Well, cost cutting and finding ways to, get rid of employees and things like that and tighten up where margins are a little bit higher. But man, it's crazy out there. Because I know right now, if you're watching CNBC or Fox Business News, or whatever you watch, or Bloomberg, I'm not picking on these guys. I watch all those shows, and I've been on all these shows. It's like a circle jerk of analysts talking about how freaking bullish they are. How the market's back. Trillions are going to start flowing back into equities from bonds. You got to get back in it. I told you, this is it. This is the bull market. We're going higher and higher and higher. If you're watching TV, that's what they're saying. Believe me, I'm watching it. It's my job to watch this stuff. That's the status quo. That's what I'm looking to discredit, because if I can, on the positive or the negative, I'm going to be able to make money on stocks and give you guys great ideas. If the market's pricing in something that I think they shouldn't be pricing in the right way, I'm going to say, hey, this is what we should do. And you do that by understanding that's like the consensus estimates. If you think they're going to come in light, you should be shorting a stock. If you think, hey, these analysts are conservative, you should be buying the stock, meaning earnings are going to go a lot higher. Look at Target. Blew out the numbers. Earnings were conservative. If you think that was going to happen, look at Target's up 18% today. We'll cover that in a second. So just remember, the guys that you're watching on TV right now, don't make fun of me, the circle jerk. You guys know what I mean. The guys you're watching on TV right now, just remember, 30 days ago when stocks were getting crushed, these are the same people telling you that you should buy bonds. The market's dangerous. It's heading lower. The same people 30 days ago just switched from everything is perfectly fine to back then where it's like, holy shit, you got to watch out in 1 month. When really, what has changed? It's really just seasonality. This is trading. And we live in this reactionary world. Everyone wants to play Monday morning quarterback. Man, listen to Steve Leeson said, if I was the Fed, I would do this. And just listen to 5 or 6 different economists. Yeah, the Fed, I don't understand. They should do it. What don't you understand? I mean, I've been critical of the Fed. Dale more than me. But man, you got to give the Fed its dues. I mean, if you had said that the Fed's going to raise rates incredibly, the way they have, and they're going to be at this level, and you're going to tell me it doesn't result in a market crash, and we still have low unemployment? I mean, what has the Fed done wrong? Don't get me wrong. You say, well, the balances and, the debt levels and a lot of politicians and stuff like that. And again, there's millions of ways you can criticize the Fed. But when I see economists go on and say, this is what I would do, not one of them would have raised rates to this level. I mean, we were talking about, even now they're talking about, well, there's no way that they're raising anymore, no pricing in rate cuts for later on. There's not going to be rate cuts, guys, this year. Unless you see a market collapse. They're not cutting rates. With 2% is their target, it's 4%. I mean, they're not going to cut rates. It's crazy because the biggest mistake the Fed ever made in the history of that institution was in the 80s. We know that. Massive inflation, they thought they had it contained, and they were wrong. They can't make that mistake again. It doesn't make sense for them to lower rates if the economy is doing the job by itself. Just leave it until you don't have to. Why lower rates? Why take the chance when you're getting the result you want? You could always lower rates whenever, but it's just common sense makes sense. And you're going to see Powell come out and talk hawkish. That's his job. He's going to come out and talk hawkish. Because he doesn't want to say, hey, everything's great, and we get the rip your face off rally to go even further. That's not his job. He's going to say, look, we're going to data dependent, and but the market's doing your job. You don't have to do anything right now. Why even push that issue? Why even, there's, from a risk reward standpoint for the Fed, one, it's a credibility issue because you said you're going to wait till you get down to 2%. We're not even close. We're not even close, guys. At 4%, we're still, I explained this, that if you take out the last 2 years, 9% to 4% is great. It's amazing. At 4% annual inflation, which we're on the core CPI for inflation. By the way, we're a lot freaking higher than that. If you really look at the data and some of the shit that was in the data, and declines in oil, heating oil, and so it's just, it's crazy. We're all paying higher prices, right? We all paying high prices. I didn't see the price of anything get lowered, right? I'm not going to Starbucks for the kids in the morning and seeing prices go lower. No. I'm not shopping and seeing prices and going, holy shit, man, look how much, going Chipotle and you're like, wow, it's so much cheaper. Nobody in the world is seeing that. Nobody in the world. Maybe in Japan, that's it. But give me a break. But at 4%, guys, I mean, it's still the highest annual inflation that we've seen since 1991 if we take out the past 2 years. So to think that the Fed is actually going to start cutting is crazy. And they've been talking about cutting, just to let you know, this was in October 2022, we were supposed to cut maybe first quarter in 2023, and second quarter, back half, we're going to cut, pricing in 80% chance of cuts and 70% chance of cuts, and we didn't cut once in 2023, and we're not going to cut in 2024 unless we have a meaningful correction in the markets, unless we get inflation below 2% and we stay at 2% for maybe 2-3 months in a row, which I don't see happening. So again, being reactionary and looking at seeing everything's great, we got to get back into the market. We don't need to be concerned. It's 1 month. Nothing has really changed. Because I'm going to leave you with this. Right now, we're currently cheering news that the economy is slowing. Think about that for a minute. A slowing economy is not good for equities. We have interest rates are still exceptionally high. Credit is tightening. We're seeing layoff announcements still. Citigroup's laying off employees. Every day we see laying off employees. That's not the sign of a strong economy. People are like, the economy's strong, it's resilient. It's not strong. We're seeing earnings grow. These companies are smart. They have a lot of fat to trim. They've done a great job of cutting costs. It's the reason why you're not seeing sales grow year over year, but yet earnings haven't grown year over year, but still they've been relatively solid. They're at the same levels they were 18 months ago, earnings. And think about that. No earnings growth in 18 months, and yet markets are 5% higher when we're used to them growing 12% over the past 3-4 years annually. In fact, you look at the PPI announcement today, great number, great by showing wholesale prices are slowing much more than expected. So when you look at that, you may be thinking, well, wholesale prices, right? These are wholesale prices, which results in, that means that we kept prices the same or charge a little bit more. It could mean increased margins for retailers. That's not the case. That doesn't happen. Okay, throughout history, lower wholesale prices and operating margins almost always move in tandem. They go up the same, they go down the same. But margins were a lot higher, even during COVID. But now, you look, especially since 2020, it's almost like identical. You got 2015, 2011, go back and see it. Low wholesale prices is not a good thing. It shows that the economy is slow, and it shows that margins are going to compress. That's what happens that's what happens. So we're cheering news that indicates growth is slowing. What we saw surprising today from yesterday, because we said, hey, the rally's continuing, it's great. Well, what happened yesterday? 10-year has come down tremendously. But this is really surprising to me because today, despite that PPI, which was really, really slow, I mean, that's a big number, like minus 0.5% compared to you're expecting 0.1% growth. And you have a decline of 0.5%. That's a big number. But today, I'm talking, not yesterday, today, the big slowdown in PPI, it didn't result in interest rates declining. They actually going higher. The opposite is happening. Why is that? Because that's not a good sign. You would think, okay, now we got more confirmation of a slow economy. So rates are going to come down even further. Why are they going higher? I would have liked to see them go lower. That's a sign, hey, this is going to continue maybe through December. I don't know. But now that they're going higher on this number. Also, as I just mentioned, inflation at 4%, it's nothing to cheer about. You could cheer because, hey, with 9%, we're going lower. Again, double the Fed's target. Double the Fed's target. And people are calling for cuts. We're not going to cut. And believe it or not, it's been July since we saw the last rate hike. It seems like it was just recently a rate hike, though. It's since July. We've had the Fed say, hey, we're not done. They're going to continue to say that as long as the market's doing, chugging along, right? Seeing inflation come down. Everyone's like, maybe inflation is transitory. Wouldn't say inflation is transitory, meaning that it's temporary. Because it hasn't been, if 2 years is your new definition of temporary and transitory, then okay, fine, it's transitory. I thought transitory meant a couple months. That's what Powell thought before he raised rates by the fastest pace in history of the Fed. You can't be more wrong than that. So I don't think the Fed's cutting anytime soon. I mean, it won't. It has too much to risk in the credibility side. Plus, not just credibility, what happens if inflation really starts surging after this? It just doesn't make sense. Especially, again, when the market's doing its job for the Fed. So if you look at this translation of what I'm saying, and not to be so macro and bore the hell out of you here, The Fed is likely to stop hiking rates. We said this a couple months ago. All right, just leave them. But Powell's going to continue to have the hawkish tone, and we're nowhere close to the Fed lowering rates, which means they're going to stay higher for longer throughout 2024, which is this constant drag, this massive drag on the economy. It's going to continue. The conditions still exist today as they did a month ago. But we are seeing inflation come down, but interest rates are going to be relatively high. Should we be higher than we were in March 2022 when we started this stuff? I don't think so. So if you did watch TV right now and they're like, hey, the bull market's back. You don't need bonds. Just get all 100% all that. When I say bonds, I'm saying that, again, bond prices and rates move inversely, but people like getting those rates and higher. So, instead of being conservative and putting it and parking that money, it might come out and go into equities again. I think that's crazy at this level. I mean, even Goldman Sachs came out with their forecast today for 2024. I don't know if you saw it. We have access to this, so I like to share this stuff. They're expecting just 5% returns over that 12-month period in 2024. So I want you to think about that, 5% returns. And not only can you see similar gains just parking your money in 1-month treasuries, right? Or an Apple savings account, risk-free. I mean, it's over 4%. But Goldman's expecting these paltry returns despite it being an election year. And we look at past election years, we see stocks, equities, 8-9% gains. They're saying, no, hold on. It's a lot different from what I'm hearing on TV. Well, got to go all in. You're only expecting 5% next 12 months? That's it? You mean to tell me instead of going the ups and downs and waking up at night and seeing everything go crazy and rates and certain things could break and, maybe we see a global meltdown and because higher rates are crushing a lot of countries, maybe we see more wars, right? Who knows what's going on? Craziness. I could just, instead of dealing with all that bullshit, I could just take my portfolio and throw it in something that's going to generate 4 to 5% right now, risk-free, and I don't have to worry about it. This is what Goldman Sachs is saying right now. So short-term, stay the course, but longer-term, be careful what you wish for. And slower growth, again, while helping to lower inflation, is also going to result in weaker profits for companies at a time when analysts are projecting the consensus estimate for next year's earnings. They're projecting to surge by 12%. Good luck with that, especially since you've done the majority of your cost cutting. I don't know where they're going to see this demand come from. Maybe certain pockets. It's not all companies. I'm not telling you to sell the markets. I'm not telling you to leave the markets. I'm telling you better be selective with what stocks you pick. So tomorrow's Wall Street Unplugged Premium podcast, Dale and I are going to break down 13 Fs, which just came out every quarter. That's the report money managers, and hedge funds. They file every quarter, show which stocks they own and are adding to and have sold. Again, it's data that's, happened 3 months ago. Some of these things they might not be in, but there's investors like Warren Buffett, lots of value investors that have, that are not these high frequency funds going in and out of stocks that they'll accumulate positions and continue to accumulate. But you get lots of ideas. And Dan and I cover this every single quarter. We get great ideas, not telling you to buy what these guys own, but they may decide to buy something that could fall 20% over the next month or 15%. These guys are going to come in and buy more. So it gives you an opportunity to just put some of these stocks on your watch list and keep an eye on them. But a lot of names, a lot of stuff to go over, some things I'm not used to seeing, some things that are pretty obvious, but we're going to break them down. All of the hedge funds, the biggest names, all the guys you could think of. It's not just Buffett, which you know about, and Ackman. There's a lot of big, huge funds out there that report. Baupost, Value Act, multi-billion-dollar funds under management, and it's significant. It really moves the needle. So we're going to cover that tomorrow. Also, we're going to break down Target in more detail, which just blew out the numbers. It's trading 17% higher today, reported earnings of $2.10. Expectations were for $1.47. Guys, it's a 42% increase, or better than what the analysts were expecting. I mean, it's an insane beat, so much so that with the stock up 18% today, it's cheaper today than it was yesterday before it reported, even though it's up. That's how crazy that beat was. And Target killed it. I mean, naysayers are going to claim sales fell year over year, though. Sales have fallen for the entire S&P 500 year over year. And the S&P 500 is up 17% year to date, while Target was down 25% heading into the quarter as of yesterday. I mean, hell, the past 12 months, guys, listen to this. The past 12 months, Apple saw its sales and earnings decline. Actually, I'm lying. Earnings went up 1 penny over the past 12 months. I think it went from $6.13. So basically no growth in earnings and a decline in sales. Yet the company increased its market cap this year by nearly $1 trillion. $1 trillion. It's trading at like 29 times forward earnings. The 50% premium to the market when you're not growing sales and earnings? Tesla, you own Tesla, margins falling like a rock. They're lowering prices like crazy. Earnings are projected to decline 25% year over year. That number was $6 a share. It's now down to $3.20. I mean, it came down to $4 and now a little bit over $4. Now it's like $3.25. So now they're projecting earnings to decline year over year by 25%. And that stock is up 90% this year. So please, and people giving Target shit about, hey, their sales were down a little bit, which, by the way, beat analyst estimates, but they're down to low single digits year over year, where most companies the same, except most companies went up in value. But Target was a clean beat. Earnings, margins, inventory levels down, guidance was solid. I mean, Target has put in its bottom. You're not going to see that stock ever hit the low 100s again. Ever. And even now, when you look at Target at where it is, the stock is trading at 15 times right now after this move, 15 times forward earnings. It's a 50% discount to Walmart and Costco, who are on deck to report earnings. And for the first time, Walmart reports tomorrow, Costco a couple weeks. But what have we seen in the last 3 quarters? We've seen Target earnings was shit, and then all of a sudden you had Walmart and Costco beat them, and like, wow, they're killing it. Now, Walmart, you better produce great results. You're trading at 30 times forward earnings. Costco's trading like at 37, 40 times forward earnings. Those guys better report good numbers. Because that's an indication that not only is Target back, they're starting to take market share. That market share that they lost, especially during COVID. But really happy to see this move, especially with Curzio Research Advisory members. Target's one of our positions in that portfolio. Really great quarter. We're going to break it down a lot further than that. And finally, Dan, I'm also going to talk about how Target's rip your face off rally, I love that term, rip your face off rally relates to small caps. Because the Russell 2000 surged 5% on Tuesday, 5%. And today it significantly outperformed the S&P and NASDAQ, I mentioned earlier, by 3-to-1 margin. I think it's up like 1.3% as I'm doing this, where everything else is around 0.5%, 0.4%. You know, I've been pounding the table on small caps over the past few months. And why? In a market that I'm like, wow, you have to be careful how interest rates, economy could slow, which usually results in bad news for small caps. The reason why I've been pounding the table, not the whole Russell 2000, is this sector, I've never seen a better opportunity to buy some of these names where they've gotten annihilated, especially into this month because of the tax loss selling. So you're looking at a 5% and then a 1.5% rally, and the Russell is still down 25% from its highs. That's how bad it's been. Why? Because everyone and all the money managers have rushed into the biggest names. Well, now, if you're trying to catch up, what are you doing right now? At the end of the year, you want to play catch up? Buy some of those small caps that are down tremendously. We're seeing small caps, names that are down 60, 70, 80% from their highs that reported good quarters. Insiders are buying. They're announced buybacks. They're growing earnings. I've been doing this for 30 years, and that's the part of the market that I love, small caps, because you really have to dig deep. I mean, everybody covers these large caps. You know so much about them. But the small caps, that's where you see the biggest disconnects. I haven't seen disconnects like this in decades. So much so, as you guys know, I put over $200,000 into one stock, another $50,000 into it. I mean, I'm going very heavily into some of these names that I really, really like. And those who are members to certain services know what stocks they are. I'm not going to give those away for free. But those are very big positions for me. Those are positions that I normally don't do because this is an opportunity not to generate 1x or 2x returns. These things, some of these names are down so much. I mean, 5x returns are possible. 3x returns are possible. Some of these names could triple and still be 20, 30% below their, 2021 highs? It's just a sector that's been forgotten, annihilated. It's trading at a discount. We haven't seen a discount like this to large caps in 20 to 25 years. That's going to change in 2024. There's a lot of these names that are going to do very, very well because they priced in recession. They're down tremendously. And these names, you're not going to see those gains where, I can hold them long term. You've seen a lot of these names. I mean, the name I put in $200,000 in is already up 100%. I've seen a lot of names up 30, 40%. These things are going to pop, like Target, up 18, 20%. That's why we're going to talk about more how Target relates to these small caps, because when everyone hates you and they're so under-owned, once that shifts and that sentiment shifts, that's where you're going to see. You don't need these things to report great numbers. You need them to go from terrible to less than terrible. And you're going to see 30, 40, 50% gains from these levels. We're going to break down some of those stocks, give you some names, some plays like we did last week. Get all Wall Street Unplugged Premium. We'll go over all of that. So look forward to that podcast tomorrow. And that's it for me. The great stuff on deck. Can't we do Wall Street Unplugged Premium? If you're not a premium member, then I will see you again in 2 weeks. And going on vacation with Thanksgiving with my family. Giving my staff the week off to do the same. And by the way, I say the same thing every single year at this time. Eat lots of turkey, stuffing. If you're a vegetarian, eat freaking salad or whatever you eat. Have some alcohol. Watch football. Laugh a lot. Enjoy the family. Be thankful for everything you have. We live in a world where I feel like the younger generation, I feel like we're the only country that our schools teach our younger generation to not like our country sometimes. And that's really sad because that's not taught any place or any country, right? And you have to be thankful, and you're thankful just when you look what's going on around the world. You have someone in Ukraine that you haven't spoken to because of the war. I mean, you're looking at the conflict between Palestine and Israel. It's just, it's when you're looking around what's going on, and the things that you have, and to hang out with your family and stuff like that, and be able to watch football and laugh and stuff like that. Guys, don't ever, 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 ever take that for granted. Seriously, don't. I'm not bullshitting. Don't take that for granted. Okay, it's really, really important. And have fun for Thanksgiving. So happy Thanksgiving to everyone. Love you guys. Thanks so much for listening. And go Eagles. Take care.